Hi everyone, we are Earthwise, and in the next 15 minutes or so, we would like to present to you our proposal to manage Canadian University Endowment Fund. My name is Hui, and joining me today are my teammates, Ronki, Thao, Vanathi, and Sam. You will hear from all of us during this presentation. Starting off with the prompt, we understand that we're tasked with managing a significant portions of Canadian University Endowment Fund, representing 20% of the total endowment fund. Objectives are clear. We aimed at achieving double objectives of long-term capital protections and net zero transition simultaneously. We also acknowledge that the net zero transition by 2032 is ambitious, given the conventional pathway to net zero by 2015. As the market is developing, we understand that we are facing certain constraints in data, guidance, and regulations related to net zero. We specify financial and net zero targets. Regarding financials, we embrace Canadian University objectives of achieving return targets SBI plus 4.5% and low risk tolerance. Regarding to net zero objectives, we approach target setting in 3 steps. First, we adhere to NZ's AOA target setting protocol recommendations, setting portfolio sectors and engagement targets to achieve CO2 equivalent emissions and make a real world impact. Second, we base our targets on various science models developed to achieve net zero pathway by 2050. Last, we tested our target by applying it to typical endowment fund to guarantee portfolio targets are feasible. Overall, we would like to achieve 50% CO2 equivalent reductions by 2025 and reach carbon neutral position by 2032. In order to achieve aforementioned targets, we developed an investment strategy built on 3 pillars. First, we invest in 3 asset classes: bonds, stocks, and alternative investments. Second, we actively integrate ESG into our investment management practice. Last, we achieve carbon neutral by both the carbon emission reduction and carbon offset. ESG factors integration will be incorporated in asset allocation guidelines and performance reporting. We also consider certain investment considerations, which can be discussed in details later. In more details, Ronki is now discussing our methodology.
Thank you. So for our methodology and investment framework, we have majorly structured it in 2 key ways: an overall portfolio approach and an asset class specific approach. For our overall portfolio approach, we have taken into consideration the net zero emission targets that we have for 2025 and 2032. We also expect the assets in our portfolio to meet our return objectives as well as the risk objectives relating to volatility and ESG. We would also be looking at general framework for ESG, such as those recommended by Principles for Responsible Investment, Net Zero Investment Framework, as well as Net Zero Asset Managers Initiative. For all assets in our portfolio, we expect them to meet the methodology recommended by Climate Action 100+ benchmark, Transition Pathway Initiative, and Science-Based Targets initiatives. Now, looking at our assets class specific methodologies and frameworks, for all our ETFs, we would expect them to be in line with the aforementioned frameworks, but in addition, for equities and fixed income, we expect our equity ETFs to meet our return objectives for total nominal return, as well as our fixed income investment assets to meet the inflation objectives. We would also be limiting ourselves to verified green or climate bonds and bonds that meet the specifications under the Climate Change Performance Index. For other equities, we will be looking at publicly listed companies that meet quality indices, but also have requirements relating to being strong, fundamentally sound stocks, and also having strong dividend payment history. For alternative investments, For our private equity funds, we would focus on consistent track records, net zero investment strategy, as well as net zero asset owner commitments. We would also be looking at the same for our direct private equity investments, and for real estate investments that we could consider in this portfolio, we'd expect this investment to have frameworks that are in line with the carbon risk real estate measure, green building certifications, as well as carbon neutrality. Bearing all of this in mind, we have identified some constraints that would limit the selection of assets that will go into our final portfolio. These constraints are relating to how our investment team would have to learn on the go, how we need to set internal targets for 2032, the changing landscape for the ESG space, as well as not having enough data or empirical evidence relating to the ratings that are given by Sustainalytics or MSGI when it comes to measuring ESG risk. Now we will look at a strategic asset allocation.
Thank you. The fund's strategic asset allocation is based on an adapted endowment model. To determine the optimal strategic asset allocation, we analyze the risk-return profile of the fund from the lens of the traditional 60-40 equity bond asset allocation and the endowment model, which is the asset allocation of some top endowment funds in the world. We noted that the 60-40 allocation results in real returns of approximately 3.7% and 11% in terms of risk, compared to 7% and 16% respectively for the endowment model. Therefore, this informed our initiatives to adapt the endowment model to achieve the desired 4.5% real return while managing risk. Next, Tao would broadly explore the products that the fund would invest in.
Thanks, Sam. So with the criteria that Rotman mentioned previously, we try to invest in the Kenyan market to identify any products that could potentially fit with our investment philosophy. The first two criteria that we use for screening are products that are available for Canadian institutional investors and have either positive or negative ESG strategy. So far, we've been able to find only 20 plus products, with some major ones shown in this slide. Among them, which one could potentially be the ones that we could invest for the fund. So for fixed income, there are two potential investments that we propose. The first one is the Desjardins Environmental Bond Fund, which invests in bonds that finance projects to have a positive impact on the environment. So for the rationale, we chose this fund because of its established track record in terms of both financial and impact returns. The average 5-year return for this fund is about 3.8%, rather good for a bond fund. And also early inception date in 2016 when SRI was not really popular. Most importantly, the fund has well-integrated ESG practice with the invest, divest, and engage role. So it divests companies that do not have ESG practice, and invest in companies that are willing to improve their ESG practice, and try to engage with all the holdings to encourage them to improve on their ESG practice. That's why we recommend this fund. Another vehicle that we recommend is something like the RBC green bonds, which is to finance the green assets. So the main reasons why such green bonds are suitable for our fund is that because of the fund manager reputation, which in this case is RBC, pretty well-known fund manager that are well known for their dedication to the ESG practice. The second rationale is a well-established track record, especially in the ESG side. They integrate their ESG practice well. RBC published their green bond reports annually with specific measures like the GHG emissions, energy safe annually, and so on. In terms of equity, we propose the NEA Environmental Leaders Fund, which about 1.6 billion AUM investing in companies that addressing challenges in water, food, waste. Pretty thematic investing strategy that are well established, that are well matched with our investment philosophy. The other reasons why we chose this fund is because of the fund manager reputation, with Impact's asset manager being the global manager, well known for their impact investing dedication and practice. Also, they have a pretty well established track record. As for Canadian equities, we want to directly invest in companies in Canada. Given that currently there are no products that could give the exposure to Canadian equities. So for the Canadian equities, we chose to invest in companies that are either passionate about ESG practice in the environmental side, or maybe have the thematic investing like renewable energy companies. So those are something like RBC, Manulife, Northland Power, and Boralex. Those companies has climate targets and measurements, and also are fundamentally good quality stuffs. And that's why we chose those companies. As for private equity, we want to recommend MK Bay Partners Fund, which invests in early stage companies in clean energy, transportation, and smart cities. So 3 reasons why we chose this fund is because of the thematic investing strategy, while matched with our investment philosophy, the established track record, and also the fund manager's experience with about more than 10 years of experience investing in the space. So next, Vanathi will talk about the governance and internal strategy.
So having proper governance and internal strategy in place is crucial for the success of this portfolio. ESG policies and measures need to be incorporated in all stages of the investment management process, starting with management's commitment to the net zero framework. We would need sustainability experts on board as well to ensure that the team is well informed on best practices. Next is performance measurement, which should be done on a financial basis through risk-adjusted returns and on an ESG basis through weighted average scores over time. Gradual increase in investing towards private carbon capture projects would also be crucial as we get closer to 2032. The team has to engage actively with the portfolio companies as important stakeholders and ensure that their carbon emissions targets are aligned with the overall goals of the fund. As advocates for transparency, we would also participate actively with market players and regulators to increase market efficiency, while also disclosing our own fund's activities to our shareholders through an annual Road to Net Zero report. This report would be a way to hold management accountable to the net zero commitment they've taken by monitoring and measuring ESG performance over time. We hope that by setting these policies in place, we're ensuring alignment of objectives for the long term. Based on all the steps we've mentioned so far, the fund is set to achieve net zero by 2032. Sam will now talk about how this transition will take place.
Yeah, so based on our target returns, we expect the fund to grow to about 1.6 billion in 2032, and our approach to achieving net zero targets is expected to result in absolute reductions in emissions and the fund's carbon intensity. So we analyzed 3 possible scenarios, which are underpinned by the assumptions we have stated below. The first scenario is based on current best practices, which has been seen from players in the endowment fund space, such as University of Toronto Asset Management. And the second scenario is based on constant emissions reduction rate to achieve the 2032 target. The third scenario, which is really ambitious, assumes that we achieve the targets for 2025 and 2032 accordingly. While these targets are ambitious, we reckon that our investment strategy, our asset allocation, and our governance structure should enable us achieve the best case scenario. This concludes our presentation. Thanks for your attention.